Hello everybody, and thank you for watching the Wealth Guard Show. I'm your host, Tom White. Oh well, the sell-off continued this week, and when we last left you, in last week's episode, we said that we were concerned about not having volume and interest at those levels we were at, and that could leave us vulnerable to any kind of selling pressures. Well, this week we got that selling pressure, headed a lot lower here, and MACDs last week also were not confirming the move in the stochastic, so we did not get back into the market. We've been out for, oh gosh, it's got to be a month now since we've been out of the market, holding on to a 14% gain in the IBD 50 portfolio. And the reason we got out of the market in the first place was because of our economic mechanic model that turned and indicated bearish signals and was suggesting that we were going to go significantly lower. We were up 22% in that portfolio, and we took a hit down to about 14% in 1 week. And that was hard enough for us. We saw the economic indicators turning around. We got out of the market, and consequently the market fell apart, and the same portfolio would now be down about 20% roughly had we held on to it. But thankfully we got the economic mechanic principles, and we'll go over those right here. And first key point, number one, the US dollar and commodities. They move in the opposite direction. And two, commodities and interest rates, they move in the same direction. And last, number three, high interest rates are bearish for stocks. And so we'll begin with the US dollar. And on the daily chart of the US dollar, down below, point number one, those stochastics bounce off the 20 line there, and they just crossed, but they're still heading sideways here, so they're not decisive enough here. They look like they're losing a little bit of steam, in fact. Gave it a yellow mark. And above that, point number two, the MACDs have not confirmed any kind of a crossing in the stochastics, as they're still trading sideways with the black line underneath the red. Histogram bars are also below zero, but they're moving up a little bit. We gave this one a yellow mark. And up top, relative strength index, still going sideways and having a problem with that 50 line there, so we gave this one a yellow mark. And on the weekly chart of the US dollar, down below, point number one, those stochastics gave us a bearish signal a while back when the black line crossed over the red, and still in decline, so we gave this one a red mark. Point number two, we got above that, the MACDs are moving sideways, and the black line is over the red. The histogram bars, they're falling down toward that zero line, so we gave this one a yellow mark. And up top, relative strength index, point number three, it's moving sideways, and just like on a daily chart, it's having trouble with that 50 line, so we gave this one a yellow mark. And summing up the US dollar, we analyzed daily chart and the weekly chart. On the daily chart, we found the stochastics, the MACDs, and relative strength index were all neutral, and we gave them a yellow mark. They slipped a bit from last week, though. And on the weekly chart, we found the stochastics were negative, and gave us a bearish signal, we gave it a red mark. And the MACD's relative strength index, they've not confirmed them yet, they're neutral, we gave them yellow marks. For a total, we got 1 red mark, 5 yellow marks, and 0 green marks for the US dollar. And now we look at the commodities represented by the CRB Index. And on the daily chart of the commodities, down below, point number one, those stochastics, they got a bullish signal a while back, black line is over the red. Had a little stall here, though, at the 50 line, and it looks like we're converging in on that red, so we're going to watch this one closely. Gave this one a yellow mark. Above that, point number two, the MACDs confirmed the bullish move in the stochastics. Black line crossed the red, and the histogram bars are rising over that zero line, so we gave this one a green mark. Up top, relative strength index, moving a little sideways here, and again, having trouble with that 50 line. Got across that, gave this one a yellow mark. And on the weekly chart of the commodities, down below, point number one, those stochastics look like they're trying to settle here. Black line is moving in on the red, and it looks like we could get a bullish signal here. We gave this one a yellow mark. Point number two above that, MACDs, they're still in decline. They're looking bearish, and histogram bars, though, they flattened out and look like they're starting to settle, so we gave this one a yellow mark. Up top, relative strength index, point number three, fell through that 50 line again, but looks like we got a little bounce here, so we gave this one a neutral yellow mark. And summing up the commodities, we analyzed the daily chart and a weekly chart. On a daily chart, we found the stochastics were neutral, and we gave them a yellow mark. And the MACDs, they were positive and bullish, we gave that a green mark. Relative strength index was neutral, gave that one a yellow mark. And on the weekly chart, the stochastics, MACDs, relative strength index, they were all neutral. We gave them a yellow mark. For a total, we got 0 red marks, 5 yellow marks, and 1 green mark for the commodities. And now we look at the 10-year Treasury yield. And on a daily chart of the 10-year Treasury yield down below, point number one, those stochastics are in oversold territory and the black line is underneath the red. That's bearish. We gave this one a red mark. Above that, point number 2, the MACDs are in decline, but the histogram bars, they're rising. We gave this one a yellow mark. And up top, relative strength index is hugging along that 30 line. We gave this one a yellow mark. And on the weekly chart of the 10-year Treasury yield, down below, point number 1, those stochastics are in oversold territory. Black line did cross over the red, but they really got to show us something here, and we gave this one a red mark. Above that, point number 2, the MACDs are also declining, and the histogram bars are dropping. We gave this one a red mark. Up top, relative strength index, it's diving below that 30 line. We gave this one a red mark. And summing up the 10-year Treasury yield, we analyzed the daily chart and a weekly chart. On a daily chart, we found the stochastics were negative. We gave them a red mark. MACDs and relative strength index were neutral, and we gave those yellow marks. And on the weekly chart, we found the stochastics, the MACDs, and the relative strength index. They were all negative, and we gave them a red mark. For a total, we had 4 red marks, 2 yellow marks, and 0 green marks. And this is telling us that money is going into the Treasuries, and that's driving the yields down. And now we take a look at the Dow Jones Industrial Average. And on the daily chart of the Dow Jones, down below, point number 1, we got a reversal on those stochastics. They failed to cross that 50 line. They turned bearish when the black line crossed over the red. And so we gave this one a red mark. Above that, point number 2, those MACDs, they were moving in on the red. The black line was moving in on the red there, and it deflected off and fell down. That was the confirmation that we were waiting for last week and why we stayed out of the market. We wanted to see that confirm the bullish move in the stochastics, and we see here that they failed to do so. They're falling down here, and we gave this one a red mark. Up top, relative strength index, point number 3, it's also failing that 50 line. It's also dropping. We gave this one a red mark. Note down below too, look at the volume picking up over the last couple of days here. Even though we had options expire, volume was still pretty heavy to the downside here. And as I mentioned last week, it looked like the market was moving higher because the sellers went away, not because the buyers came back. And on the weekly chart of the Dow Jones Industrial Average, down below, point number 1, those stochastics, they continue to decline. They're approaching that 20 line, but they look like they're going to penetrate, and they got a long way to go before they're oversold. We gave this one a red mark. Point number 2 above that, MACDs, they're still declining, and the histogram bars are dropping too. We gave this one a red mark. Up top, relative strength index, it continues to approach that 30 line, and it's dropping. We gave this one a red mark. And on the Dow Jones Industrial Average, we analyzed daily chart and a weekly chart. On the daily chart, stochastics, MACDs, relative strength index, were all negative, and we gave them a red mark. On a weekly chart, same thing. They're all negative, all red marks. For a total, we had 6 red marks, 0 yellow marks, and 0 green marks. Not looking good for stocks going forward into next week, and I gotta say I continue with my target here of 9,750 on the Dow. I had this target here since, about 3-4 weeks ago now. And so we've been coming up with scores for the US dollar, the commodities, the 10-year Treasury yield, and the Dow Jones, looking for where the strengths are and where the weaknesses lie. We did that by analyzing the number of positives and weighing them against the number of negatives and coming to a conclusion that way. And in first place this week, it was the commodities, the CRB Index down below, 1 green mark, 5 yellow marks with 0 red marks. And it's being led particularly by precious metals and mostly gold. US dollar came in second place this week with 0 green marks, 5 yellow marks with 1 red mark. Dollar's in decline right now, moving in the opposite direction of those commodities. Third place, it was the 10-year Treasury yield, 0 green marks, 2 yellow marks, and 4 red marks. Money's flowing into Treasuries as the Fed has been pumping money into them since the downgrade of the S&P. Dow Jones Industrial Average came in last place with 0 green marks, 0 yellow marks, and 6 red marks. Looks like we're going to head lower in stocks, and things are not looking good right now for the Dow Jones. And we take a look now at our market gauge. The object here is to be as far in the right column in bullish territory as possible and as far away from the left column in bearish territory. And in first place this week, it's the commodities represented by the CRB Index, pulled mainly by gold and precious metals. It's moving into bullish territory, and the US dollar is moving in the opposite direction. It came in second place and is moving into bearish territory. Third place, it's the 10-year Treasury yield as money is flowing into the Treasuries themselves. That's driving the yields lower. And Dow Jones Industrial Average has been selling off, and money's coming out of those stocks, and they're actually going into the Treasuries, bypassing cash dollars and going into gold. Seems like people are looking for gold everywhere right now. every week around this time we do our IBD 50 portfolio. And a few weeks ago we went into cash, and we've just been eliminating stocks as they underperform each other each week just to have a little fun, but it's only 2 stocks left right now, so it's really not a lot of fun to compare 2 stocks against each other. So I'm going to go ahead and do a review this week of our transactions and why we got out of the market. We went back on July 26th, and we saw some bearish indicators in our economic mechanic model, and decided, okay, it's time to get out of cash, out of stocks and into cash rather. And we sold off all of our positions and had a total gain of about just under 14%, as we started out with $10,000 and ended with $11,382.07. So we went into the cash. We've been eliminating those stocks. We held on to Carbo Ceramics a little long. We held on to it a couple extra days because they were going to have earnings, and we thought we would pay to see what those earnings were, and we paid dearly, all right, because they didn't do very well. We got hammered in that stock there, and we went from 17% to down to 13.82% just because of that 2-day hold on that stock. Pretty significant. It shows you don't want to be emotional about these moves in the market. You want to actually just use the mechanic model and have a strategy to get out of these stocks and listen to that strategy rather than your emotions. So this week I'm looking right now at going into some other stocks out there. We're going to hold on to cash right now. We're not going to add anything right here. I'm looking at some of these gold stocks and mining stocks that are showing up at the IBD 50. So I may do a show in the middle of the week or a blog update where we get some of those stocks. I'm not really sure yet, as I'm still reviewing some of that. That's all we're going to do for this week. We're going to hold on to the cash. So tune in again next week, and we'll do this again, and we'll review all of this again. Tune into the blog as well and look for those updates. But for now, I'm out of here.